Hello, I'm Peter Towers, Managing Director of ESS BIZTOOLS. Welcome to this COVID-19 Survival Panel webinar. And today we're going to talk about Be a Hero, offer virtual CFO services, and key components of cash flow management. Welcome to those of you who are watching this as a live feed on Facebook. Our presenters today are Paul Barnaby, who's the Regional Integration Consultant for Asia Pacific for Plan Guru, and Paul is also a Predictive Accounting Consultant. And I will be the other presenter, and I'm the Managing Director of ESS BIZTOOLS. If you have any questions, can you please go to chat and type them in, and I will get answers to the questions sent to you by email. Or if you're watching this as a live feed on Facebook, please go to peter@essbiztools.com.au and obviously send me the email and I will get the answers back to you. Be a virtual hero for CFO delivery, Chief Financial Officer, is going to be delivered today by Paul Barnaby, the Regional Integration Consultant for Asia Pacific for Plan Guru. And as I said earlier, Paul is a Predictive Accounting Consultant. We pre-recorded Paul's interview, so we will now present it to you. My pleasure to introduce you to Paul Barnaby from Plan Guru and also a Predictive Accounting Consultant. How are you today, Paul?
I'm great, thanks, Peter.
Paul's presentation is Be a Hero Virtual CFO. So it's over to you, Paul. I'm going to switch the screen across to you.
Thank you.
And you're on. Thank you.
Okay, thanks very much, Peter. As Peter has just said, my topic today is Be a Hero Virtual CFO. And what I'm talking about is you taking advisory services to your clients in a CFO role, which will turn you into a bit of a star in their eyes. And the way that you do that is by using predictive accounting. Because with predictive accounting, this allows you to show your clients the steps to financial success. So what's it all about? What is predictive accounting? Well, predictive accounting is nothing more or less than doing for future accounting periods what we're used to doing in compliance work for past accounting periods. So we're predicting what the future revenue statement, balance sheet and cash flow will look like, and we need to do this in internationally accepted reporting formats because that's what the historic accounting does. So why predictive accounting? Why don't we just work out some strategies that we think might work for our client and set them on that trial without doing it? No, because if you're using predictive accounting, this will enable those strategic decisions to be made far more quickly so that you can help your client unlock greater profits, improve their cash flow and achieve their goals. How's it done? Well, in my case, it's done by using the key drivers of revenue, cost, and of course capital items and translating these into those predicted financial statements. So, what makes me passionate about predictive accounting? Well, a little bit about me will help you with that. I am a chartered accountant. I was for 16 years managing partner of a second tier firm in Wellington, New Zealand. And before I get too many Bledisloe Cup jokes. I get 10 bob each way, Peter. I'm a Cossie, I'm a Kiwi Aussie, I have dual citizenship. But it's interesting, during that time when I was in general practice, one day I had what's called a light bulb moment. And when the light came on, I suddenly realised I had had historic accounting up to the eyeballs. I had had tax even further up, right to the top of my head. And I decided there must be a better way of doing things. So that day I set upon a plan to change just about everything I did in the way of my practice. I abandoned all the tax work, I abandoned all the historic accounting, and I started working in strategic planning with my clients. And since then, I've pretty much specialised in that area of predictive accounting, financial analysis and strategic planning, and of course that includes budgeting and forecasting. As Peter knows, after I'd been doing this in my practice for a few months, I went and did a bit of a survey with a few of my clients. And the response I got was surprising. To an individual, to everyone had the same response. Paul, what took you so long to learn that this is what we've been wanting you to do for a long time? So I leave that thought with you in the earliest parts of this presentation, because your clients don't ask for it, but that's what they want. Currently, I'm CEO of Beyond Accounting Technologies, which is my own consulting practice. And as Peter referred to, I'm the regional integration consultant for Asia Pacific for Plan Guru, which is a company based in the US. Only a US company could come up with a fancy title like that. But what it means is that I support their product, which I use just about every day in the predictive accounting scenario. It's a purpose-built tool for that prediction of profit and loss, balance sheet, and cash flow. So I've worked with, over recent years, many hundreds of CFOs, both virtual and full-time, accountants and business managers, and I like to think that I help you look like a superstar. So let's have a think about budgeting methodologies. When I first started budgeting all those years ago, the only methodology that we were really told about was what I now call traditional budgeting, which is looking at last year, maybe adjusting a bit for inflation, and that's next year. Well, I'm probably a bit blunt on this, but a good guess might be better than that. Because what's next year got to do with last year or the year before? Maybe nothing. And so you've got to use a methodology other than the traditional budgeting. The real toughie is what's called zero-based budgeting. And that's where you wipe the slate clean, you have no budget at all, you look at every line in your profit and loss and balance sheet and start from scratch. Very complicated, very time consuming, and again, while it can give you a good result, it's not as good as what I think is the best methodology, which is what I call key driver budgeting. And this is where we look at things like sales quantities, price, what have we got invested in inventory, what terms do we get from our suppliers, what terms do we give to our customers. That's looking at a driver on a line-by-line basis. And if you're going to have effective predictive financial statements, this is what you need to do. You might think that's a bit daunting and a bit time-consuming, but really it's not, as you'll see when I show you an example in a little while. Okay, so in the past, when you've needed a budget, what do? You reach for Excel, or maybe today Google Sheets, right? No, wrong. Why do I say wrong? Excel and Google Sheets are great tools, but they were never built for that purpose of predictive accounting. And if you have tried to build a three-way budget in Excel, you'll know what I'm talking about. It's extraordinarily difficult. You have multiple sheets. Here's a little anecdote for you. The only time I ever saw it done properly, and this is not to say there weren't errors in it, but properly in terms of formulas and its end result, it wasn't just a spreadsheet. It was 3 workbooks and 156 sheets. How complicated is that? And would you recommend Excel in place of Xero, Maya, QuickBooks, etc.? Of course not. And why would you use it for predictive accounting? Because it's just as important to get that predictive accounting right as it is your historic financial recording system. If you're really interested, there's a real nerdy fellow called Ray Panko. He's at the University of Hawaii, and he researches published Excel or Google Sheets. And his research shows that 91% of them have got errors in them that the authors don't know about. I repeat, 91% have got errors in them that the authors didn't know about. In other words, Ray discovered them. That's pretty scary stuff. And also, if you're going to insist on using Excel to build your budgets, it's going to take you 10 times as long as a purpose-built tool in any event. And on that topic, there are a choice of applications out there. You need to choose the best for technical and investment value, and you might have more than one. I support Plan Guru because I believe it is the best detailed three-way tool, but there are other tools out there which you'd want to use. Products like Fathom, which is a diagnostic and goal-setting tool. Products like Cashflow Story, which is a really good communication methodology to use with your clients. So you might want to use maybe a combination of Fathom and Plan Guru, or Cashflow Story and Plan Guru. But in any event, you've got to do that detailed predictive profit and loss balance sheet and cash flow. So here's an example of an income statement which has been prepared in Plan Guru, and I'm going to show you the app working very shortly. But as you can see, that's a month by month with a year-to-date total there in pretty traditional format. Here's a cash flow report. Some would call it different things, but it's done in internationally accepted formats and shows the 3 types of cash flow: operating cash, investment, and financing. And then shows you a net increase and decrease in cash and calculates the cash at the end of the period. And that, of course, ties up with the balance sheet that you're working on. Okay, and there's a balance sheet as well, again in typical format, and that's what it's all about. So you'll probably share these reports, although that's just a screen, it's not an actual printed report. You'll share these with your client, but I also very strongly recommend that you use a dashboard. And in this case, this comes with Plan Guru, so that you can do things like bar charts and pie charts and line charts. But the important thing here is that it is designed individually, client by client, because different things switch clients on differently. So you should have, as I said, a dashboard available. Okay. So before I go there, let's just go and have a look at Plan Guru itself. I'll open the app. Coming back to the income statement. And this is what we were looking at on the slide just a minute or so ago. So you can see there, it's just month by month. This company that I use in my case study is a computer reseller. They sell hardware, software, printers, and accessories. And we have all the details, including their historic data. So there on the extreme left is their historic year for 1920. And in the succeeding columns, of course, I've got the 2021 budget. I talked about drivers before. I'll lead you through some of those as we go now. But if you have a look at the non-financial tab, you can see here that I've captured all the units of products that they're going to sell. And better than that, when I drill down, you can see that I've done it by saying, in the case of the PCs box only, we're going to sell 2,200 units. This company is very seasonal. It's 40% of its sales in only 3 months of the year. And I've asked Plan Guru to allocate that across the year based on seasonality. And that's how it's translated to 147 units a month in the low months and 293. The link between that and the dollars takes place here, where I've said use those unit sales and apply a price of $450. Down in the cost of sales, we know the cost per unit. So here I've used the same data, in other words, the unit sales, and said each one costs $321. That's our cost of sales. And so that's how, and then down in the overheads, I won't get down into too much detail there, but there's a lot of automation built into this product. You can calculate depreciation automatically. Superannuation here is calculating automatically. There's lots of supporting schedules. So for example, I've got a really good schedule on wages and salaries there. And here you can get extreme amounts of detail, up to you, but here's an example of where I've got a salesperson on top of a salary getting a 1% commission on total hardware sales. So lots of detail if you want it. And that's why I say that I prefer Plan Guru, because it is what you want it to be. You build the level of detail. Okay, so that's just a very quick introduction. If I go to the balance sheet now, I again talk about drivers. If I have a look at accounts receivable here, you can see I'm picking that we'll get 70 days average collection on accounts receivable, and I tick over here the revenue lines. If you've got different revenue lines with different collection rates, Plan Guru will look after that as well. In the case of inventory, you can see here I'm using days cost of sales at an average of 120 across the year. You can run lines of credit and term loans. I've got a bank account down here, which has got a limit of 500,000 line of credit, and you can see that reflected in. And notice here that that is exceeded. We've gone up to our limit, and so we're showing negative cash up here. Now this illustrates the what if capabilities of Plan Guru, where you can say, what if I couldn't handle that negative cash? The reality of this case study was that the stock level, which was shown in the balance sheet, as I said, at 120 days, actually drops down to about 90 in that busy period. So we can quickly say, well, what if they did achieve that 90 days? So have a look at that negative cash up the top here, negative 350. Once I apply that 90 days, have a look at what happens to that cash flow deficit. Gone. Gone in October, small deficit in November and in December. And I might have some other strategy that I need to do. But then we start to build the surpluses over here. So we've got March, we've got a cash. So that shows you how quick it is to make those sort of changes in Plan Guru. Okay, I'll just go back to my slides a moment. Oh, one thing I want to also share with you, yes, before I go back to the slides. Once we've put our budget in, we can pull in actuals. And I have imported the actuals. In this case, I've used Excel, but there is a direct integration with Xero and also QuickBooks and QuickBooks Online. And once you've got the actuals in, of course, you can do a budget actual comparison. Let me find you a report of those. Okay, so there's a report on the December budget versus December actual. I'm just in the trading section of the revenue statement for the moment, but if I scroll down, I've got all the overheads there as well. So variance reporting, very important, compare budget with actual. Why did we under or overachieve? Those are the issues. Plan Guru also has a very exciting tool which allows you to share any data in Plan Guru with Excel. Now, I've bagged Excel as a tool for doing this job, but it's a great reporting tool. So have a look at this report here. I'll just maximize it, where I'm comparing budget with actual with forecast, because we also need to be able to do a rolling forecast. So I've got variance budget to actual, variance forecast to actual, and then I've got year to date. Now, a lot of your clients won't want that amount of detail, but it just shows you what you can pull out of Plan Guru very, very quickly after you've set it up. Okay, so just to show you how that happens, I'll just open the file after it's been turned into a rolling forecast. Won't be a tick. Because the concept is that once you've set your budget, it should be set in concrete and not changed. However, what you do need to do is to have a rolling forecast. So now my original budget, you might have noticed, was 66,000 a month and 132 for that sales of PC box only. The actuals came in, and then we've got a forecast here, which is a mixture of those actuals and the remaining budget going forward. You can update that budget to be a forecast item without affecting your original budget, because it's been what they call archived, put on the shelf. So let's just go back to the slides for a minute, and let's have a look at an example of strategies. Okay, so in this particular case, my computer company, we were asked as advisors, how are we going to increase profit? How are we going to increase effective cash flow? And so we did a test based on whether we increased the number of computers, etc., that we sold, or whether we looked at price. Now, you might think at first sight that by increasing the quantity of the products that a client's company sells, that might be the best and most effective. But not always. You've got to test each client scenario. And when I tested this one, my question was, should we increase price or should we sell more product? And here's the outcome, looking at the effect on profit and the effect on cash flow. So a 10% price increase is going to put $350,000 on the bottom line before tax and interest. And it's going to put nearly 300,000 positive into cash flow. On the other hand, if we increase volume by 10%, it's 105,000 addition on profit and less than 10,000 on cash flow. So in reality, when you discuss these matters with your client, you've got to have a look and say, well, could we take that price increase? Well, in the case of their PCs, they sell PCs at an average price of $850. It means that it's gone to $935. I've actually prepared a separate Plan Guru file to look at that, and it took me about 5 minutes to change the prices and take them up 10%. And then you can report that. I'll just go and grab that report. Not this one. Now this report here also illustrates another capability of Plan Guru. Plan Guru has a official link into Excel, as I mentioned a few minutes ago, and you can see there on the Excel menu, here are the PGR, Plan Guru reports. And I have compared those two files that I just was talking about, one with the total revenue of 3.5 million and another one with that price increase up to 3.85 million. And so you can see their cost of sales stays the same because there's no difference in cost of sales. So gross profit goes up from just a bit over $1,050,000 up to 1.4. The gross margin goes from 30 to a whopping 36, and income from 387, operational income that is, up to 736. Obviously there's some difference in tax down here. And then in terms of cash flow, you can see the huge difference that we've got there. The cash at the end of the period for this year was $80,000 when we started off, and when we added the 10%, it was nearly $300,000. So quite a significant change. Okay, so just let me take you back and quickly go over, where's my slideshow gone? There it is. Go back into Plan Guru. And I just wanted to finish off by just showing you a couple more features of Plan Guru. You can have ratios. So you can see there all the typical ratios are there. And it also enables you to insert your own ratios. So if you've got particular KPIs that you'd like to put in for your client, for example, sales per employee, sales per product sold, those sort of issues you can have those there. In terms of reporting, there is also a cloud-based reporting tool which comes with Plan Guru called Plan Guru Analytics. And here it is here. I mentioned the dashboard, so this is the real report that we're looking at, and this can be viewed by your client at any time of day or night, obviously, as long as they've got a smart device. That is secure, and so it's got a two-level security, and so your client can log in as long as they've got the appropriate passwords, etc. So just to sum up, if you're going to be a hero with your clients, you've got to be a virtual CFO. If you're not doing it now, I warmly encourage you to get on with it. It's great fun as a practitioner. I certainly still enjoy it. It gives me a daily buzz, but it's something that you've got to do. Arm yourself with tools like Plan Guru, and as I also mentioned, Fathom or Cash Flow Story, and just get on with it. Your clients will thank you for it. And the next call you get won't be about how much tax they'll pay, it'll be how can we make even more money. Peter, I'll stop there. I know that we'll handle questions at the appropriate time, but if you have any questions right now, fine.
Thanks very much, Paul. Yes, I'd just make a comment. Obviously, the key to all this is accountants being able to use this key driver budgeting concept. And when I was watching your presentation, and I've seen your presentations many times, of course, my mind goes back to some of the original budgets that I did in a public company environment where we didn't have computers like this, and they were done on dissection sheets by hand, pencil, rubber, ruler, and dissection sheets. And when the boss would come to me and say, what happens if we changed it? And we were in the meat industry, so we were buying and slaughtering cattle and sheep and pigs, and he wanted to change the numbers, I'd have to say, come back tomorrow night. I'll have it recalculated for you. And you're showing us there in seconds. It's great. And this gives the flexibility that accountants can have to be able to really sit and communicate with a client and immediately slot in the figures, doesn't it?
Absolutely right. Yep.
So the clients, I think if the accountant works with the clients in this way, the client's going to get some real ownership out of this document, because they're going to know that they've had their two bobs worth. They've asked for various things to be changed. They can see it's immediately changed, and at the end of it, it's basically their document. Whereas in the older way of preparing budgets and cash flows, the clients really didn't have much input, did they?
Absolutely right. And that's why I talked today, Peter, about this process of predictive accounting is a collaborative process. You don't do it for them, you do it with them.
Yeah.
So you can, with a product like Plan Guru, you can say, well, look, if we took the inventory up or down, this would be the effect. And you're showing it as you speak.
Yeah. And I think that's the great benefit of this.
And that's where technology is so fantastic.
Yeah.
And that allows that collaboration. Whereas when you were on your spreadsheet with a manual or Excel, you had to prepare it for them and then show it to them. And then, as you just said, they come back and say, well, can you change this? Well, I'll see you in 2 days. Yeah.
and you had sheet number 90 or whatever. It was a complicated affair. Okay, so that's great. Sorry, Paul.
Okay.
You have
No, I'm all set.
Okay, I'm just going to take the screen back, And
Okay. You want me to stop mine? Do I have to stop mine?
yes, thanks. Yeah, and for at this stage, and I'm just going to move on, and I'm going to look at some of the key components of cash flow forecast today. I'll just put the video panel back up so Paul can still be with us, because this fits in with much of what we've been looking at, or Paul's been talking to us about here. So I want to start first of all with customers, debtors, because what happens there has got a significant impact on your cash flow. And the first thing that accountants need to be conscious of, when we always need to go back to the beginning, I think, is what are the terms of trade? And some of your clients don't bed these down. They leave it open-ended. They say, pay us when you want to pay us. Well, that's a disaster. Cash flow is king, and it gets back to the terms of trade implemented with the customer way back at the beginning. So if your terms of trade for your client are 30 days or 7 days or whatever, they need to be confirmed and then followed through. And your clients need to be getting the invoices prepared correctly and promptly. It's no use, as some people still do, sending invoices out weeks after the transaction has been acted on, you know, so the customer's got whatever product or service that they were going to receive, and then along 3 weeks or 4 weeks later, in some cases at the end of the month, comes the invoice. Well, where do you think that gets put in the priority to make payments? I think it's human nature that the customer says to themselves, well, this mob's got plenty of money, they're not chasing it, so I can put them in the 60-day payment column. So making sure your customers, your clients are getting their customer invoices out is vital. And then the debtors statements. Now, not everyone is still sending debtors statements, but if your clients are, they need to be dispatched, I think, no later than 48 hours after the end of the month. Because again, the same situation arises. If they get sent out 3 or 4 weeks later, well, the business just doesn't treat them as a high priority for payments. And one of the things that can be calculated using Plan Guru, the way Paul just showed you, is to do particular analysis on debtors. I think the debtors days outstanding that Paul was using there was 70 days, but if he suddenly changed it to 100 days or even higher, and there's been various articles in the Financial Review over the last few weeks that's saying there's going to be a massive blowout in debtors days outstanding. I think it's now time for you to be communicating that to your clients and making them aware that they need to really be doubling down on their overall control factors around their customers and then in their debtors ledgers to make sure that they are going to try to control this blowout in debtors days outstanding, because there's a lot of businesses out there just haven't got a lot of cash flow at present, so they haven't got any spare money, and they're going to try to delay as long as they can the payments. And following up debtors is a high priority job. It's not the junior's role to be following up the debtors, and I think that's a big mistake that a lot of people make. So this all flows into how you then present to your client the financial forecasts, because virtually everything that you've got on the screen there at present affects the cash flow forecast exercise that Paul's just taking you through. You need to make sure these basics are being sorted out. The next area I want to refer to is inventory. And it's the same type of thing. Stock purchases need to be closely examined. I've seen some horror stories over the years of someone going to a sale somewhere and thinking it's a great idea to go and buy $500,000 worth of old equipment or secondhand equipment or roofing materials and all sorts of things, and expect that they're going to be able to be used and substituted for something else or turned into cash. And 3 years later, you're wandering around a yard that business owns or is renting, and you find all this equipment. And you say to them, well, what happened here? Oh, well, the boss went to to a sale and couldn't help himself, an auction, and bought all this gear, thought we might use it. Well, we'd already gone ahead because he'd already authorised us to buy similar equipment. So we had that and we installed it, and then we've still got this, what is now junk, $500,000 worth of junk. So stock purchases can be very important. I think all your clients should have a stock investment budget, and you can run that through Plan Guru in that key driver budgeting Paul was referring to. Run the stock budgets. Now, a lot of businesses use those. I acted for a major jewelry retailer business, and he lived by his stock budget, and he'd negotiated payment terms with those manufacturers of jewelry, and all that needed to be documented so that they knew where they were. So that brings in this terms of trade with suppliers. I think as accountants, we should be, and this is part of this chief financial officer role, really talking to clients about trying to negotiate longer terms of payment with specific suppliers. And that's what used to happen in the jewelry industry with a particular client, as I just referred to. He was getting terms of trade of 7 or 8 months for purchases in November that were going to be there for the Christmas trade, but he wasn't having to make payments until July the following year. I really hadn't seen too many other people negotiating those sorts of terms. Now, admittedly, he wasn't one store operator. He had some volume, but perhaps your clients can do the same thing. And what should be coming out of this system also then is critical data. Paul referred to the key performance indicators then. And you can get this when you match your actuals with your budget forecasts to get some feedback as to what really has happened. In your budget, you may have had a certain department's going to get a markup of 120%, but what did they achieve? If they only achieved 97%, there's basically going to be a problem in the cash flow forecast because there's not going to be enough money flowing into the system. And one of the big things you can be looking at is stock turn rates. Please don't do it overall, break it down. And again, you could utilize the key driver budgeting section of Plan Guru to be able to monitor those things. You see anything differently in any of those items, Paul?
No, not at all.
Okay. And obviously you've got to monitor the overall investment in stock because this can get out of whack at times. You know, the business has normally got an investment in stock of around $500,000. Admittedly, most retail businesses build up before Christmas, but you need to know how much you can factor into build up to. And obviously Paul's shown you how you can do this exercise using Plan Guru to do the calculation. If you think you need or your client needs that stock limit to go to 900,000 up by 400,000 for their Christmas type trade, what's the cash flow effect, especially if they haven't negotiated extended payment terms with those suppliers? Are they going to have the cash to be able to make the payments when they're due? The next area I want to refer to today is work in progress. A lot of people forget about work in progress. Professional firms like accountants and lawyers and architects and engineers are well aware of work in progress because that's where the work that's currently being performed is being charged, of course, until it's billed. But most tradies have also got work in progress and people lose touch of it. So there needs to be an appropriate system that, as accountants, I think you should be talking to your clients and making sure they do have a system that makes sure that any external purchases that the company, your client, has made for one of their customers is appropriately processed through the work in progress system. If you're doing monthly accounts and doing proper reconciliations, if there's been a mistake in that, it should become pretty obvious. But I've seen stories where an invoice wasn't allocated, and normally they're for fairly big amounts, so it should have stuck out. But because the business was not doing monthly accounts, it basically stayed as an overhead expense, and it was never charged to the client. That's a complete 100% loss for the business, especially where they've been undertaking work, and this particular business was where they were doing it on a cost recovery type basis. So it never got into their system and it never got billed to the client. And at the end of the year, when the accounts were being prepared, they had this $20,000 sitting in their overhead expenses. It's too late to go back and charge it then. Allocation of labour is also important to the work in progress calculation, so that the client needs an appropriate system. As their accountant, more so wearing your chief financial officer hat, which I hope you're very keen to offer that service to all of your business clients, you will want to make sure that their labour has been allocated appropriately together with the labour overheads. And don't forget special expenditure. Think about the things that can go wrong. It's not a direct purchase as such, it's not labour, but there might be something else. Your client may have paid for an engineering report, for argument's sake, and the bill comes in and no one knows what it's for, and it gets again thrown into overheads. And then a long time later, you realise it was something that was supposed to get charged to a client. And one of my pet areas here is making sure progress claims are being raised. And that gets back to the original agreement with the customer. I think they should always say that while something might still be in work in progress, that a progress claim can be made, because otherwise the cash flow is going to suffer. And this will be reflected in the business running out of money. So making sure progress claims are made I think every couple of weeks during something that's tied up in work in progress. And then there's a report that the leadership team can analyse at the end of the month to see how things have gone. So that's work in progress. Capital expenditure. I suspect some people are going to get a bit blown away with the 100% write-off rules that are now being brought in. You've got a budget for this type of expenditure. Where's the money going to come from? You still need the cash, or you're going to be borrowing the money. It sounds great, 100% tax deduction, but you got to have the money. And where are you reflecting it in the budget exercise and the cash flow forecast that Paul just showed you? And please don't get too carried away with 100% write-off. You've still got to be looking at what is the return on investment on this particular acquisition. Even though the government's giving you 100% write-off, it is still an investment from your company's point of view. The other contributor, I think, to controlling cash flow is creditors. First of all, what are the terms of trade that have been negotiated? And please talk to your clients about negotiating longer terms. I read an article in the Financial Review last week that a major retail organisation in Australia has been paying some of its suppliers on a 6-monthly basis. Now, the article doesn't quite say whether the manufacturers agreed to that or they were basically told that that's how they were going to get paid. But that retailer had gone to their manufacturers and, in effect, either directly or indirectly by not paying them, told them they were going to pay them 6 monthly. So your clients need to be trying to have some control over when they have a legal responsibility under their agreement to pay their creditors. And this means monitoring the amount owed to creditors. If you've agreed, your clients agreed to pay some on a 40-day basis or 60-day basis, it's important to monitor if they are being paid. And creditors' days outstanding is also an important KPI the business needs to know. And if you can get some changes in the creditors' payment terms, it's going to affect your cash flow forecast. And that's where you can go back in and do the exercises that Paul was showing you. The other area I just want to refer to is business funding. So what does the cash flow indicate? Paul showed you how by putting in various debtors' days outstanding, creditors' days outstanding, obviously capital expenditure, dividends, loan payments, and everything else that goes on in a business, there's going to be a cash flow forecast. And if when you've done some exercises to determine where you want to take the business in the future, which might be a growth activity, you're going to open a new store, or a new branch, or a new factory, or a new hotel, or whatever. What's the extra funding that's going to be required to do that? That will show up in the budgets and cash flow forecasts. And then the big question is going to be, where's the funding going to come from? It's pretty dangerous these days to just think you can just keep on increasing your overdraft unless the bank has agreed to it. So where's that funding going to come from? Well, these days, it's borrowing. So it's money that's going to be contributed by the shareholders or the directors or friends of them, or going off and seeing a bank or a financing organisation. And that then raises the question of security. Is the business going to have adequate securities that can be offered to the lender? Or should a capital raising exercise be looked at to raise this money? And the capital raising could come from crowdsource funding, equity raising, if the company is very young, under 3 years of age, and has developed a new product, process, or service. It could come from an early stage innovation company. Or we could utilize Section 708 of the Corporations Act, which has been there for 35 years, but it is a great way to raise up to $2 million if you've got up to 20 investors that will put that sort of money into the company. So Paul, that's my commentary on some of the other issues that people need to be thinking about when preparing budgets and cash flow forecasts. We need to be thinking through just how all this fits together, so that there's some real intelligent thinking gone into the compilation of the final reports that you were so adequately showing us.
Mm. Yeah, great, Peter. I think that's in relation to my side of things. The reality is when you go through those various items that you've covered, that you can measure the outcome if you were to improve or have a disadvantaged outcome if your customers start paying late. So in every case, you want to be able to measure the effect of these, and that's what the predictive accounting is all about. It's no good saying, well, I think it's going to be bad news on cash flow, and we'll find out when the bank rings up and says you've overdraft. You've got to be a bit more scientific than that. And that's why you've got to be a virtual CFO. There is nothing that replaces that communication with your clients on these issues.
Okay, so thank you very much for your contributions today, Paul. And we will be following up with any questions, and I'll be passing them on to you. So if you are watching this today or at some later time that suits you, and you do have a question for Paul or for me on what I've said, please send me an email, peter@essbiztools.com.au, and I will pass those questions on to Paul, and we will get back to you with an answer. So thanks, Paul. Have a great day.
Okay, thanks, Peter. You too.
Okay, thank you. Bye.